Elliott waves, we start by identifying a wave that fits these three rules. This will tell us that we are in the correct beginning, or we've correctly identified an actual Elliott wave, not just an uptrend. And this is, once you have this, you can then keep moving it forward. So now we have guidelines. Now, a guideline is not a hard and fast rule that can't be broken. It is a tendency. Sometimes that happens so often that it can almost qualify as a rule, except for the times that it doesn't work as expected. The guideline described below are useful ways of applying Elliott wave analysis that have shown their validity over time. But as they are not rules, they may not work every time. And the only way you're going to get the hang of this is to practice it. Okay? Because I can't tell you 99% of the time the rules work, or 98%, but when the rules don't hold true, you can actually see why they don't. Okay, and you can then say, okay, I can see the Elliott wave, and there was some freaky thing that happened in the market. You know, Donald Trump came out and made a speech. Something happened in Arizona. A bomb went off somewhere that threw something out of kilter a little bit, and you can then qualify that you still fit the guidelines. So guideline 1 is called the guideline of equality. And these are very, very important because they will help you also identify the subwaves and also later help you decide where you put your stop loss and your take profit points. Now, the rule of equality says that the two of the motive subwaves in a five-way sequence will tend towards equality and is generally true for the non-extended waves. This means that when wave 3 of an impulse wave is the extended wave, wave 5 will approximately equal wave 1 in price. And this is price movement, not in value. Okay. So what we can see here is wave 1 moved this distance. We would expect wave 5 to come down eventually and equal the same distance. Why it happens, I can't tell you. I've never done the studies, but it happens. Okay, because remember, the market is all about the battle between the bulls and the bears and the psychology of the markets. But under the guideline of equality, wave 5 will most likely be equal to the same climb as you had in wave 1. Now, this doesn't say same price. It's the same distance. So if this was at 0 and it climbed to 1 and then eventually made it up here to 10, this would then be expected to decline 1 to 9. So that then helps you put the value of where you might set your targets, where you might want to put your take profit point or look for a reaction at this point, or where you can see the next impulse wave. It's starting to give you useful information. Now, guideline 2 is the guideline of alternation within an impulse wave. Says that the forms for wave 2 and wave 4 will alternate. If wave 2 is a sharp style of correction, wave 4 will be a sideways style of correction. If wave 2 is sideways, wave 4 will be sharp. It is useful in anticipating the end of wave 4 correction within a suspected impulse. So in other words, if the move between here and here is a very sharp climb, you would expect an equally sharp climb here. Okay. So wave 2 and 4 will alternate. So wave 2, let's do this again. Alternation. Impulse waves, wave 4 and wave 2 and wave 4. Okay. Will alternate. So if wave 2 is very sharp, you're going to expect a flat rise to wave 5 and wave 4 to 5. So if wave 2 is sideways, wave 4 will be sharp. So if this is a sharp correction, this will be flat. If it's the opposite, if this is a flat correction, this one will be sharp. So it's called the law of alternation. The guideline of alternation within a correction wave says that the form of wave A and B, now remember, A and B are the two beginning waves of the downtrend. We have 1, 2, 3, 4, and 5, which are the impulse waves moving up. And then A, B, and C are the downtrending waves moving down. So wave A and B will alternate within a three-wave correction. If wave A is flat type of correction, if wave A is a flat type correction, wave B will be a zigzag type of correction or vice versa. It also states that if the correction begins with a more simple wave for wave A, expect following B and C to be more complex. It's very easy. If the guideline of alternation says things will alternate, okay, so whatever pattern you have for A will then alternate to B and C. So if you have a very flat wave for A, B will alternate, okay? If B is maybe a zigzag type of correction or vice versa. It also states that if the correction begins with a more simple wave for A, expect the following waves B and C to be more complex. Now, when we talk about complexity and involvement, remember, here we're looking at a sketch of a simple wave. But price doesn't move like this. Price will be moving up and down. And remember, we're going to have these repeated waves in ever-diminishing patterns, like spirals in this wave. You will see when it means more complex, it means that there was more waves going on within that wave. Okay. Guide 4, guideline of depth of correction, says that when the market goes into correction, it often will correct to the territory of the previous. Wave 4 or lesser degrees. This does not necessarily mean that it will reach the bottom of wave 4, but rather that we should expect it to reach the span of the previous wave 4 to a lesser degree. Okay, so when we go to our correction phase is the A, B, and C. Okay. We would expect, see the move between 3 and 4? We would expect this to be the dip for C, so C should maintain level 4. Okay. And A should be at level 3. Very easy. Okay. This is how deep, not the price, how much depth the market has declined or inclined. So in other words, it's price, but it's price on an angle. Okay, guideline 5. The guideline of channeling is really a technique to project the potential end of a wave within impulses. Although channeling can be used for corrective waves, it really boils down to the application of trend lines and doesn't have any hard tendency to correct applications. As for impulse waves, Elliott noticed that channel lines often mark the boundaries within sometimes dramatic precision. Okay? In other words, when the waves are moving in these channels, they will have dramatic accuracy. It will be amazing at how often these exact numbers or predicted numbers occur. Now, there are 3 ways that channeling can be used for projecting the end of waves, but they all use the same technique. They both require 3-point beginnings and ending of waves. To create their channel, one technique for projecting the end of wave 3 One technique is for projecting the end of wave 4, and one technique is for projecting the end of 5. Because finding out where they should end is very, very important. Projecting the end of wave 3. So we're moving up. We've got 1 going up, 2 coming down. 2 cannot be below as low as 1. So we know how far it can fall. Okay, so as price is coming down to the equal to where 1 is, we would expect it to rebound. Now it's going to go into wave 3. We want to be able to start projecting price movement. Okay, so we do this. We can draw a trend line with the beginning of wave 1 to the end of wave 2. Project a parallel line off the end of wave 1. There is a potential for wave 3 to end when it reaches the projected trend line. Projecting the end of wave 4. Draw a trend line from the beginning of wave 2 to the end of wave 3. Project the parallel line off the end of wave 2, and there is a potential that wave 4 correction to end when it reaches the projected trend line. And then wave 5 is draw a trend line from 3 to 4. Project a parallel line off the end of wave 3, and there's a potential for wave 5 to end when it reaches the projected line. So it's not that complicated. It is just putting it, each one is different because each wave is moved differently, and you're trying to project where the angle that it should be moving on and project where the tops will be. Guideline 6. The guideline of scale is really a technique for looking at the market and is often applied when creating channel projections. It simply states that one should use both an arithmetic scale chart and a semi-log scale chart when looking at Elliott waves. Arithmetic and a mathematic scale chart are good for looking at waves on lower degrees, but semi-log scale charts are good for bringing larger trends into perspective. Now, in a few minutes, we're going to go to live charts and actually see the Elliott waves on current charts. So we're just going over the guidelines first, and then we're going to go over to the actual charts and see what they look like on real live time charts. Now, waves have personalities. Okay, and this is what you have to do. You have to get the grasp, just like trend lines, support and resistance lines, Gann fan. You have to get a grasp. You have to understand the personality of the asset as well as the personality of the current market to understand exactly what's happening. Because even though we have rules that are steadfast, we have guidelines that are flexible, and you have to understand, whether you have a kid and, he comes home from school in a bad mood, or your husband gets up tomorrow morning and he's in a bad mood, you know exactly what to expect. You know he's going to grunt to your coffee. You know he's probably not going to call you during the day. You don't know why he's in a bad mood. He just woke up. You have to understand the players or the personalities involved. Now, wave personality is a reflection of mass psychology acting in the market. The emotions that flow from optimism and pessimism, creating the structure we see in the market. The personality of each wave is the same whether it is a higher degree or a lesser one. Please keep in mind the wave cycle. 1, 2, 3, 4, 5, A, B, C. So we have impulse wave, correction wave, 1. So impulse wave 1 goes up. Now we can use the distance that impulse wave moved in price to help project what? Impulse wave 5. Impulse wave 2, correction wave 2 would not be able to fall lower than wave 1. So each wave's got a set of rules. Wave 3 can not be the shortest wave in the overall movement of the Elliott wave. Wave 4, the corrective wave, will help predict what A of the impulse wave should come to. And so each one of these, as you get to know the personality, you can actually start to see exactly what you can expect, because the markets don't work clean. They do work in all mysterious ways. Now, about half of the first waves seen are part of the basing process and tend to be heavily corrected by wave 2. Many people feel that this is one more opportunity to trade in the direction of the previous trend. And if that was down, many will sell short. However, market breadth and volume will subtly increase. Now, Elliott waves are a tool. They're a technical analysis tool. There is no technical analysis tool that by itself should tell you what to trade. They are in combination of other pieces of information that make, number one, your trading decision, number two, to tell you that you should be entering the market, and help predict what, where the price, where you should put your targets for. Elliott Wave will help set these for you, but they are not standalone. So you need to look at other things with them. So having lines of support and resistance, having trend lines, and volume at least will help. So when you're pushing up to wave 3 or pushing up to wave 5, and you've already adjusted, calculated what you think 5 should be based on 1 or what 1 should be based on 4, done your calculations, put your trend lines on there, and get ready. You need other verification features. Now, the other 50% of the first waves will rise from large basing price movements formed by the previous correction, and these tend to be dynamic and only moderately retraced. This is a good probable spot to have a wave 1 extension. Second waves tend to retrace so much of the wave 1 that most of the profit gained are eroded. And because you can't predict exactly where a wave will end, especially at wave 1, to trade going up in wave 1, you will lose your profit in wave 2 because it happens quickly. Okay. So you need 1 and 2 to start getting ready to trade for 3. However, during wave 2, most investors convince themselves that the bear market is here to stay. Okay, and this is where the fallacy is. Wave 2 is where you should be getting ready to buy at the bottom to ride into wave 3. Third waves tend to be strong and broad. They are typically unmistakable, as confidence in the direction of the new trend is clearly evident. Now, what you should see is in wave 3, an increase in volume. Okay, you see price breakouts, continuation breakouts. Okay, the third wave of an extended third wave will likely be the most volatile point of strength in the new trend, and things like price breakouts, continuation gaps, volume expansion, and increased breadth will accompany it. In a third wave in a stock index, nearly all the stocks will participate. Because of the dynamics of the wave, it will provide the greatest clues to the corrective wave as the corrective waves count as it unfolds. Now remember, we're looking at wave 3. That is this wave here. This wave is long. So in this long wave, you're going to have smaller waves. When you see wave 3 of the smaller wave under the larger wave, it's at that point you should start seeing market volatility, but it will still continue up, but be prepared for the volatility. But this is the point where all the bears are pushed out of the market and all the bulls are jumping into the market. Okay. Wave 4 and 5th wave. 4 waves can be predictable in both depth and form because of the guideline of alternation. Remember, we talked about the guideline of alternation. They tend to differ with the previous wave 2 of the same degree. They often trend sideways, building a base for the final wave 5 to spring from. In a fourth wave, in a stock index especially, lagging stocks will tend to build their tops and start declining. Okay. Fifth wave. Fifth waves tend to be less dramatic and display slower speed of price change. Fifth wave is when the uptrend is burning out. The traders are getting undecided. The price has still got the momentum to carry up, but not with any conviction. Of course, in the fifth wave is the extended wave. This will not be the case in terms of a price change. In advancing fifth waves, optimism is extremely high despite narrowing of breadth. However, the fifth wave of an extended fifth will lack the change of the previous waves and give clues about a change in direction. Now, once we've hit the top of 5, we're going to expect the markets to start moving down into the corrective phase and go into A, B, and C. During wave A, the public is convinced that this is just a correction of the previous trend and will rush into capitalize on it despite any technically damaging waves. This sets things up for the next wave to follow. If wave A is divided into 5 subwaves, it will be a zigzag. So remember, each wave should have its subsets in it. And if wave A is divided into 5 subwaves, because remember, up you have 5, down you have 3. So we have up 3, you have a 5, 3, 5, 3. Now in the subwave of A, you can have the 5 subwaves. It will be a zigzag. It is divided into 3 subwaves, and it will be a flat or a triangle. Wave B catches people in the wrong direction. What happens when we have wave B, okay, people are just starting to say to themselves, oh, it looks like the uptrend is over, we're going into a downtrend, and they're starting to sell into the market, and then wave B occurs and it catches them all in the wrong direction. It performs the task of enticing the suckers to jump into the market. This is where bears and bull traps happen. As a general rule, B waves tend to show lower volume. So this is what you would be looking for in B. Now, B wave is, remember, we have 1, 2, 3, 4, 5. Then we have A. B is when the market is bouncing up off the first A. So what happens is we should have low volume. That means this upward move is got no conviction to it. And this is where what happens is the suckers jump into the market to think this is the continuation of the uptrend, where it isn't. It's wave B of the downtrend. Now, wave C. Wave C tends to break the illusions of wave A and B. In a declining market, it can be devastating and fear takes over with broad participation. So what happens is we have wave A, which most traders haven't caught on to. It is a downtrend, a reversal of the uptrend, and moving. So they're just saying, well, they're saying, wait, no, we're just waiting for it to rebound back into the uptrend. They see wave B correct, and now they're all sure it's going to go back up to this uptrend. They jump in the market, only be devastated here as the bears take control over it and continue down in this marketplace. And what happened is fear takes over. All of these people are jumping out of the market. Okay, so this is what actually creates this wave C. The fact that wave C may do this in a 5 subwave helps the deception. So remember, not everybody's looking at Elliott Wave, so they're looking at uptrend on their charts, and they're seeing these up price move this way, this way, this way, this way, this way, and when it comes down to this way, and they're looking at their support and resistance line, and they're saying, okay, it's a correction, and we're going to go up. If they're not, Elliott Wave will help you see this, that it is moved into a C impulse wave, and that uptrend is really over, where all these guys here are getting faked out. Now, it's a lot of information to process, but it's not complicated. Once you have it, because the rules don't change. So once you have it pretty well down in your head and understand how to spot these and understand what the rules are, it's not difficult. It's like if I told you to, back in the old days when I first started learning how to drive, we drove manual shifts, stick shifts. And, it was this thing, you had to put on the clutch, shift it in the first gear. Then you sit there and listen, decide when you have to shift to the second gear, when to shift to the third gear. And, there, when you first learned, there were rules, take it first gear, let it rev this high and only so many miles. But after a while, you could tell by the sound of the engine. You could tell by the speed you were going. You tell by the incline on the hill. You could tell if the stoplight is at the top of the hill exactly how to guide up there. And you learn how to use your clutch with your gas pedal. And before you knew it, you were just doing it. Well, all of it, if I gave you all of those rules for shifting gears into different markets, into different trends, and told you when you're driving to work and you're driving on this one road, you're going to have to shift up, shift down, shift up, you get totally confused. But after a couple of weeks of driving to work, guess what? You don't even pay attention. You just know what to do. Your body knows. And that's what happens with the waves. You have to learn the patterns first and learn what they mean. Now, in a downtrend, there is a possibility of what we call a 5-5. 5 impulse waves up, and it could possibly have a wave D and a wave E. It's very rare, but there could. And you usually only see these in the subwave in a corrective phase. So when you're in a wave A or wave C of a corrective wave, in the subwaves, you could see a 5-wave pattern. Okay. Wave D shows up in horizontal triangles. If the triangle is contracting, it often is accompanied by an increase in volume. This is because it does not fully retrace the previous wave and is moving in the direction that the market is about to take after following wave E. Wave E shows up as the last wave in a horizontal triangle. Okay. It often stages a false break of the trend line on the boundary of the triangle before the market takes off in the opposite direction. If the triangle has a wave 4 and a rising impulse, it would instill a bearish conviction before the market shot up to produce waves. Thus, wave E is often attended with emotional psychology playing against the investor. Now, putting Elliott waves to use will take some practice. Nevertheless, if you persist in applying the rules, eliminating non-conforming accounts and not trying to make up your own, and looking at the personality of the waves you're accounting, you will find satisfaction in applying the Elliott wave theory. You will prove to yourself that the market indeed conforms to these waves and that there's meaning behind them. You will often find that it's necessary to adjust the count you made to perform new data. Don't get frustrated by having to make adjustments. It paves the way to a more accurate wave count and helps to refine your skills. This is something that is expected in doing Elliott wave analysis, as the skill is in applying it comes through practice. Not every nuance of Elliott wave theory has been discussed here. There's all different types of little possibilities. You have to practice this to get to understand it. But there's all different types of different interpretations. We have grand supercycles, cycles, primary cycles, intermediary cycles, on and on and on and on and on. Okay. But it's great to combine this. The two that work together very well are Elliott waves and Fibonacci retracements that never use a single indicator. Now, remember, we have alternation, depth of corrective waves, extensions, wave equality, channeling, volume, the right look, and the wave personality. So you have to take all of these in consideration. Now, there is tons of literature out there on Elliott waves, and we're not talking about reading how to get rich trading Elliott waves or my version of trading Elliott waves. There is lots of research, theoretical information available on the internet that will teach you and show you how to find these exact rules. These are the real rules. All the rest are strategies that people have adjusted to say, oh, this is how this works. Make this trade, make that trade. First, you need to learn all of these. And if you just do a search on the internet and just do Elliott wave alternation or Elliott wave depth correction, you will find lots of examples and lots of understandings. Now remember, under alternation, and we're going to go over these real quickly. Alternation, waves 2 and waves 4 of impulse. A sharp of wave 2, sideways for wave 4. Now, wave A and C corrections. Okay. Now, depth of correction waves. Second waves will tie with the Fibonacci will match at 50, 61, 78.6, or 88.6 to retrace. Extensions. Wave 3 of an impulse is the most common in the stock market. Wave 5 in commodities and currencies. First wave extensions are very rare. Okay. So here you can see on my diagram where we've actually combined Fibonacci numbers, and look at how you would draw your Fibonacci down wave B and look at look at how it tied directly back to, I just jumped off that page. Okay, exactly to wave A. So if we would have had this on there, we could have seen it correcting and coming right back through, and we could have seen all of this all the way through. Channeling, okay, again, is very, very important. It's drilling your channels, your base channels, using the correction phases. Remember, we talked about putting the channel up by using the trend line and a parallel position, a trend line and a parallel position, and a trend line and parallel position. And this will give you these channels that those waves in the sub-channels should touch. And when you see an Elliott wave, you can almost see when it's in the right direction and the right nuance. So here we can see on the left one, this is what an Elliott wave should look. If we look at wave 2, we can see, number 1, it's not valid. Why? Well, look at what it looks like. It's not a market impulse. You need to find something else, because look at the difference between 3 and 4 and then 4 to 5. None of the rules held true. We go to the ones on the right, we can see all the rules holding true, and 5, and the one, let me circle it. Here, whereas not here. So there is a steady progression in Elliott waves. So we see 1, the bottom, large degrees, questions of existence, survival, depression, war, immediate degrees, recession, panic, limited wars, minor, often accompanied by bad news. This is how we would see the bottom here. Then it's going to rebound from undervalued values, and we call this recognition of survival. It bounces back here, and fundamental conditions are not as bad. 3, 4, 5, and look at how we built the channel around the 1, 2, 3, 4, and 5. So you see the channel being built. You see the waves holding to the rules. Wave 2 did not come below wave 1. Wave 3 remember, wave 3 cannot be the shortest. Wave 1 was short. Wave 5 was long. And then we're looking for wave 4 to almost have the same depth as wave 1. Okay. And this is the progression of an Elliott wave. Okay. So let's go over, we only have a few minutes left, so let's go over some live charts and take a look at these on real live charts. Let me pop them up on your screen. Okay, now this is a chart for Nike. This is a 1-week chart. And what we see is the perfect Elliott wave dropped on here. We can see, let me put my marker on here for you. See the beginning of wave 1. Wave 1 goes all the way up to here. We go back to the corrective phase into 2, 3, 4. Now this is where the market stopped. We're expecting 4 to come as low as this, but we're not sure where wave 4 ends yet because the market hasn't reached it yet. And then we're going to expect 5 to come up to this level. Okay, and these are all easy to do. Now, the nice thing about this is you can put the Elliott waves on your chart fairly easily. You have to find them, but almost all new charts will offer you, if you come over here, the ability to put the Elliott wave patterns on your charts. You just click on it and it will drop it on your charts. You just have to tell it where to start. and it just does, it will lay out the 5, you have to figure out where they're going to go, but you don't have to do all the mechanics of actually putting it on your chart, very complex, and it'll mark them for you and everything else. Now, here we can see the Elliott waves in several movements. We've located wave 1 here with the bottom of a, now we're looking at here's the Euro JPY again in a 1 week. We've located the swing low and the beginning of wave 1. Wave 2 comes down, holds higher than wave 1. We go into 3, 4, 5. Then we start A, B, C. We go back to 1, 2, and it's very, very tiny. If you notice the move, 3, decline, 4, 5. Now, if we were to drop this down to a shorter time frame, we would expect to see in these waves, subwaves. So here we're looking, if we go look at A, and I'm just picking A because it's the center of my screen, we can see push, thrust, push, thrust, push, thrust. So we actually have in this gap a 5-prong Elliott wave. B, 1, 2, 3, 4, 5. Okay. And if we were to drop from those, in each one of those legs, we should see additionals. Okay, then lastly, we can see the combination now of using Elliott waves and subwaves, and you can see the A's, B's, and C's at the capital are the primaries, and then the small letters and small numbers are the subwaves, where they're now in combination of using 2 other indicators, which will help us determine, let me turn off some of this stuff for you so we can get rid of a lot of this garbage that's on your screen. So we can actually see the entire development of the wave, and here we're in our, here's A, B, C, and each one of the colors numbers, you have several subsets within larger sets of these waves, and you have your channel here. And this is the current euro, the USD, the New Zealand dollar against the US dollar in the current market position. We've now topped out at B of it, inside impulse wave, and we have C of the wave coming back up. Okay. So we're at the point of looking for some type of progression. So we would expect price to come back down at some point to the large B right here. Okay, and then correct back up here to its final C. But you can see the subsets. So we have, let me get my marker back on here. We have A. Let me find B on here. I don't see B on here. A, B. Okay. So we're in the middle of a AB corrective. So we had A to B here. So we need to have B to here and then C. We're in the middle of that. It's just the beginning of the very, very long term. Okay. Now we have in here within the A to B, we have A, B, C, D, E, F of the subset. Okay. So this is how you would apply. But what it comes down to is actually having to spend your time finding where you are. And the only way you're going to find where you are is you have to find find one. Okay, too many people say, look at that, where I can start my A, B, and C here because I'm in a downtrend. No, if you don't find base 1, you can't put on A, B, and C. You can't say this is 2 of 3 or 3 of 5. You need to find where, and just go back in your charts until you can find A, because you need your A's to start establishing your rules. And because you have to figure out where you stand in the middle of this movement. So as you notice, I can go all the way back in this chart. So this is just the beginning of 1. Okay. And we're all the way up here now. So it's identifying where you can find. So thank you very much. Remember, this is fairly easy once you've learned the rules, but you have to learn and understand how to find these. Okay, there's nothing simple in the markets, and those people that want to think in a 1-hour class, you're going to master Elliott waves and get the whole concept down, you're not. And for those of you who did not come to class 1 and are now picking up from class 2, you missed all the explanation of what all of these waves are and what the subwaves are and what they are. So you can't start learning in the middle either. So what you need to do is go back and learn from the beginning. Learn the basics of Elliott waves, what are considered extensions, where do you find them, how do you plot them, and then move forward. So thank you very much for joining us today. Have a great week, and thank you for joining us. Have a good night. Bye now.